Hello, good morning one and all. I am Dr. Manoj Kumar NV, working as Associate Professor in the Department of Management Sciences. So today we are going to discuss about venture capital and its advantages and disadvantages. The subject entitled Banking and Financial Services. And the subject code is 18 MBA FM 301. So we are in the unit 5. Credit rating and so in the previous class we are discussed about what is venture capital and what is the process of venture capitalists. They do evaluate the projects or proposal for a business to make an investment. So today we are mainly concentrating on what are all the advantages and disadvantages of venture capital. So here we have both advantages and disadvantages in venture capital. So first shall we discuss about the advantage of venture capital. So the first advantage is wealth creation. So wealth creation and expertise. So wealth creation. So as you know that whenever there is a new establishment of company or businesses with their own idea or with their own innovation method or technology, if they want to inculcate into their businesses, and whenever they are stepping to such businesses as a startup businesses, at that time they need a huge amount of wealth, and that wealth need a high amount of capital. So when there is a large amount of capital, obviously that is depends on the size of the company and the nature of the company, that is describes about how and what are all the ways that they can able to ensure their wealth creation. So therefore whenever they are coming with the new type of the company or new type of the industry or new technological oriented company with their own proposal or with their own business plan, if they want to start up a new company, then that company has undergone with the venture capitalist finance for that projects. So therefore whatever the amount of investment the venture capitalists they made, that will be a help out to the company towards creating a wealth as well as expertise to the company, because the management that is shared by the venture capitalist. So because the proportion of the capital which is made by the venture capitalist, so therefore there is a chance of participation in the management by the venture capitalist. So therefore it will be helpful to the company towards creation of wealth as well as expertise to the company. Then coming to the second one, where you can have a large sum of so in the venture capital, one of the best opportunities to you can as an enterprise or as a company, you can have a large sum of equity finance will be provided through the venture capital finance. So therefore once the venture capital they exit from the particular business, obviously it will be left to the equity finance. So therefore even though they are in the part of the company as a management body or management board member, even though that they have a very less proportion of equity base as a private investment, the rest of it which will be offered to the public through IPO. So therefore, there will be a chance of having a large sum of equity finance in under the venture capital. Then coming to the third advantage, so when we take a consideration of any business, they couldn't able to stand the obligation to repay the money. So therefore, here even though the business they not stand, so means the credit worthiness. So the credit worthiness of the company is most important, and so therefore there is a need of monitoring and supervising the continuous evaluation which is required to make the new company or startups to earn better profits. So therefore there is a need of Ports Corp. So whatever the management functions, each functions that going to be evaluated, and there should be a careful steps must need to be carried forward towards make the organization into more profitable. So therefore, for any businesses or for any organization, whenever they does not stand to meet their obligation to repay the whatever the money which they are collected from the venture capitalists, then the people they are involved in the particular business to make the business into profitable. So therefore, at least they are expecting the particular business to meet the payback of whatever the venture capitalists are invested. Then in addition to whatever the capital formation to the company, it also provides variable information. So where sometimes it is most valuable information, where each and every functions of the organization that is managed and controlled by the venture capitalists, because they are in the top board. So therefore, whenever they are in the top level, obviously they take care of the rest of the departments, and the valuable information whatever they are going to be shared or whatever the resource they are going to be shared, and technological assistance and even managerial assistance they do provide to make the particular business into more successful. So therefore, whenever we speak about the success, it's not just with the end results. It is about whatever the steps they carry to make the organization into more effective and efficiency, that will be resulting into a better success. So therefore, that initiation which is take place by the venture capitalists to make, rather than just capital formation, they are also helpful to the organization by providing the managerial assistance, technical assistance, information sharing and resource sharing and expertise. They are helpful to the organization to make a critical decision making. So critical thinking abilities that will be helpful for the organization towards take a strategic decision making. So these are the major four, where the fourth one is where they are going to be sharing of valuable information, and whatever the resource sharing. So it might be managerial, financial, and they also do provide technical and managerial assistance. So these are the major four advantages of venture capital. Then coming to disadvantages. So in disadvantages, whenever we consider the investor, they become a part of owners. So therefore, as we know that equity holders, we used to call it as the real owners of the company. So as same here, as the investor, they are considered to be a become a part owners for a business. So therefore, the autonomy and control of the founder is lost in the venture capital. So therefore, so it is linked to this point, where whenever we given a chance to the outsiders, other shareholders or any investor, to participate a maximum proportion investment through the equity or any other investment mode, then the control will be dilute. So therefore, it will result with the autonomy. So the autonomy and control of the founder is lost. So one who put his thoughts or interest or innovational idea, if he is not made much investment into the particular enterprise, then whatever the large sum of equity that is invested by the external players of the organization, they become the part of ownership. So therefore, once they are achieved the greater proportion of the capital base, obviously they can have a autonomy towards the ownership, as well as it will be reduced or it will almost control control the entire power of the founder. So he may going to lose whatever the investment and even the administration and management role he may miss out due to the reason that the investment is diluted by outsiders. Then as we know that when it is venture capital, so there will be a several process which is involved in the venture capital funding. So therefore, the continuous supervision and scrutiny which is taken place with respect to whatever the plan they produce, and that is get the approval, then they are going to evaluate, due diligence they are going to do, then there will be a exit after they make it into a profitable business, then they are going to exit by providing the opportunity to the IPO. So therefore, the process itself are lengthy and complex. So lengthy and complex with respect to whatever the process of venture capital funding. So therefore, there will be many steps or process which is involved towards providing the funds from the venture capitalists. So therefore, even though it is a easy way to raise the funds for your organization when the initiation is very good, or the plan or creativity is much better compared to the competitors, then it is the very good source of fund which you can able to afford to your enterprise. But still, there is a lot of process which is involved towards get the approval and evaluation for your business organization, and even sometimes it takes a more time in the time of scrutiny or evaluating the particular documents, and whenever they do bargain with respect to profit and all, there also there will be have a complication with respect to fulfilling the particular process. Then coming to the third disadvantage, where we have we can call it as it is an uncertain form of financing. Uncertain form of, yes, we can call it as it is uncertain form of financing, because sometimes even though the project is worthful, the venture capitalists, might be have a chance of rejection. Sometimes the projects are very profitable, but the venture capitalists, they are not ready to fund it at the particular time of startup. So therefore, sometimes they do provide the funds even though the projects are moderately good, or sometimes they are going to be provide very less proportion of the capital even though the project size is large. So therefore, we can call it that as a uncertain form of financing. Sometimes they may get because of the project is very worthful or fair project. Sometimes even though the projects are fair, they couldn't able to get the finance from the venture capitalists. So therefore, we can call that as uncertain form of financing. Then whatever the benefit of venture capital finance, so it is the benefit only in the long run. So therefore, whatever you are enjoying the benefit through the venture capital financing, only you can realize it in the long run. So therefore, there is no benefits in short run. So in the sense where the venture capital, because they do the large amount of investment, whatever the amount of investment they made, that is going to yield, and it will be take the minimum gestation period of around 5 to 6 years to result with the better profitability or better return to the investor. So therefore, it will be a very good option for the long term investment who are ready to make a long term investment. For them, they can able to prefer the venture capital finance, where they can easily get the expected return more than the expected return in the venture capital finance, because the involvement of the individual who are the venture capitalist or the businessman, both they are working for a higher profitability. So therefore, you can able to encash that opportunity to make higher the profits as well as return to the investors. Then coming to the exit route. So exit route is most important content here, where other venture capitalist, he must need to be exit from the particular business after he climb the whatever the principal amount as well as expected return from the particular business. So at that time, we have a few options are available for the exit of venture capital to cash out their investment. So the first exit scheme which the venture capitalist they can afford is, that is IPO, initial public offer. So as we said already, that once the company taken a existence and once the company create a goodwill or reputation in the market or brand image in the market, obviously the share price may goes up in the security market, and even the trading will be the demand and supply for the particular shares are very high, because the volatility will be more when the company have better profits. So therefore, it is allowed the particular investors to have a large sum of equity to the company. So therefore, at that time, the venture capitalist, they are going to be sell their shares, or they are going to be issue a new shares to recover whatever they do the investment in the particular company. So therefore, other venture capitalists, the first option they have is they can preferably go with IPO, initial public offer, they can able to do it. So therefore, that will be encash their investment at the higher price. Then promoter buyback. Promoters So promoters buyback in the sense where who are the people who are involved and who are manage the business, who are contributed their ideas and innovational techniques, rather than the high proportion of capital investment. So those are, they are ready to fund it again for the particular business, and they can able to buy back whatever the proportion of capital the venture capitalists they are invested, that amount the promoter itself they are going to be invest, they are going to pay it to the venture capitalists to get the proportion of capital, high proportion of the capital coverage by the promoter. So therefore easily they can able to buy back directly from the venture capitalist by making a buyback. So therefore their shares as the owners they are going to be buy back from the venture capitalist. Then they have another one option is mergers and acquisitions. So therefore they can able to sell the particular company or merge with the other company, that is also are acquired by the other, or they can go with, yes, they can go with, they can conglomerate between together with the equivalent firm. So therefore they can able to encash whatever the investment the venture capitalists they made. So they can able to do the settlement through mergers and acquisition through corporate integration. So therefore the corporate integration, which is also helpful to make, because the bidder price will be always higher than whatever the book value of the company when the company is established well. So therefore whatever the additional price which are deal value which you got, so that you can able to make directly payment to the venture capitalist. Then the last option for the venture capitalist is to sell to other strategic inventor. So means sale to other strategic investor. Sale to other strategic investors. Like if other venture capitalist funders they are ready to funding on the existing project, then they are going to be sell the same project at the high price. So therefore they can able to easily get whatever they do the investment in the particular project. So therefore these are the major 4 methods which they are going to be used in the venture capital exit option for return back there whatever they do the investment as a venture capitalist. So then we can move into the kinds or example for venture capital financing companies. So examples for venture capital financing companies. So where in that we can able to take the part of few companies who are performing very well in the providing funds to the startup companies. So those are we will discuss one by one, where we have a Kohlberg Calls and Robots, we call it as KKR, Kohlberg Cars and Robots. So it is one of the top tier alternative investment asset management in the world, has entered into a definitive agreement to invest $150 million, approximately 962 crores in Mumbai based listed polyester maker JBF Industries Limited. So the firm will acquire 20% stake in JBF Industries and will also invest in zero coupon compulsorily convertible preference shares with 14.5% voting rights in its Singapore based wholly owned subsidiary of JBF Global Private Limited. So the funding provided by KKR, which helped JBF complete the ongoing projects. So as we know here, where the venture capital, they are going to participate in the investment. So where they are going to be acquired the 20% stake in the JBF Industries. So where the proportion of capital, whatever they do invested, that part of the company they are going to be acquired. So even though whatever they provide the funds by investing 150 million US dollar, so that is going to be helpful for them to acquire 20% stake in JBF Industries. Also, they are invested 14.5% convertible preference shares. So, therefore, even though they got 14.5% voting rights in the headquarters, like whatever they have only subsidiary in the Singapore based JBF Global Private Limited, in that also they got the voting power of 14.5%. So therefore, the whatever they do the investment, that is going to be helpful for the Kohlberg, Kars and Roberts towards upcoming projects of JBF. Then we also can find the localite, we can call it as pepperfry.com. So I think all of you heard of pepperfry.com. So where it is the India's largest furniture and e-market platform, has raised almost $100 million in a fresh round of funding led by the Goldman Sachs and GDS Technology Fund. So Pepperfry will use funds to expand in footprint in Tier 3 and Tier 4 cities by adding to its growing fleet of delivery vehicles. It will also open new distribution centers and expand its carpenters and assembly service networks. This is the largest quantum of investment raised by a sector-focused e-commerce player in India. So therefore, the major concentration here is to expanding their branch, and they are going to be expanding their services in Tier 3 and Tier 4 cities. For that, they are going to get the almost $100 million they are invested by the venture capitalists. So therefore, that will be helpful for them to expand and explore their service network in the, even though in the Tier 3 and Tier 4 cities. And it is the one of the largest quantum of investment which is raised by the particular sector focused in e-commerce in India. So then we can also, these are the we can give enough two example for the venture capital finance. So hope you can understand how it will be makes the entrepreneurs to gain the particular opportunity to make an investment, as well as they are also provide the chance to the venture capitalists to be a part of the management, and they are going to be have a platform to the expertise people to take up a right decision for the organization. So these are the sort of advantages and the disadvantages which we are focused today, so that we can able to say that where the venture capital always given an opportunity towards go global, and even you can go ahead with the strategic integration process for expanding your units and exploring the new ideas and thoughts. And even though as an entity you are given a platform to the other players to or other competitors, as a venture capitalist, they can able to take over the particular company at the higher price. So that is also one of the way that you can able to make the organization into more profitable. So therefore, because whenever they used to bid for the particular organization, it is not the new one. So it is already established and existing organization in the market. Obviously, they are going to price higher than the market value when they are go for bidding option. So therefore, you have an opportunity to make early returns. As we discussed, one of the drawback of venture capital finance is to the benefits you can't able to expect in the short run, because it will take the long run towards give you a better returns for your investment. So henceforth, what you can able to do for cut down or to minimize this drawback is to you can able to make the organization into better existence and create a goodwill and product promotion and better uh, platform which you are going to be create for your products and services, that is going to be helpful to reach the public very easily. Once you create a brand image or the good name in the society, surely that is going to be helpful to you to target by some other strategic investors who are ready to invest into your company. So therefore you can sell it to them at the high price. So therefore you can able to recover your amount of investment along with the high amount of returns. So therefore whenever as a new company you want to start up, or whenever you think for uh, uh, the investment, expecting a large amount of investment, that amount of investment can easily rise, but the process is little bit lengthy process, but still you can easily able to get the funds, whatever the required funds for your organization, easily you can able to gain when the project is more effective and it will be a fair project. When it is a fair project, surely you can able to encash the particular opportunity to make a funding by the venture capitalist to make your dreams into true, as well as it is also provide the chance for the venture capitalist to have a greater returns for their investment. So because when we start up our own business, we need to be take 100% risk, and we make the particular organization into more effective unless we concentrate properly, or we are not managed properly, or we are not taken a control properly. Surely they are not in the position to have better profits. So but here, even though they are ready to make an investment and they also take a control in the management to, and also they are going to guide the organization to make it more effective and efficiency in the productivity or whatever the expected results or targeted results, they make the organization into proper action to be take place through the venture capitalist. So therefore we can conclude that when we considering the high risk involved in the venture capital investment, because they don't know about anything about our business or about us, still they are accept our project to make an investment. So therefore we can call that as a high risk investment. And complementing the high return expected, as I said, when the risk is high, the return also will be higher. So therefore even though whatever they do the investment for the particular business, whatever they are contributed as a venture capitalist, they are anticipating very high rate of returns for their investment. So therefore sometimes it may not give an opportunity to receive whatever they are expected. Sometimes beyond their expectation they are going to be receive the returns. So one should do thorough study of the particular project being considered and weighing the risk return ratio expected. So one needs do the homework both on the venture capital being targeted and on the business requirements. So therefore they must need to be very careful. They have to plan for both, whatever the point of they must need to be concentrate from the point of venture capitalist, as well as they must need to be concentrate from the point of business requirements. So therefore when these two working together, obviously the success rate will be very higher, because it is very new to the market and the idea is going to be helpful to create very high amount of brand image and goodwill to the company. So therefore, once it is established well, the everything whatever you are going to be received, that only the entire return, and it is a very good platform for the investors. They can able to enjoy with very high rate of returns as venture capitalist. So hope you understand about venture capitalist. So therefore, it will be helpful to you to take up the best opportunities or whatever you have ideas that you can able to encash with the help of venture capitalists towards startup. So thank you one and all for your listening. Thank you.